Hello, everyone. Welcome to Wall Street for Main Street podcast. My name is Mo Daoud, and today's special guest is Robert Murphy. Robert Murphy is the Austrian economist and a scholar of the Mises Institute, where he teaches at the Mises Academy. He also runs the blog Free Advice and the author of The Political Incorrect Guide to Capitalism. He also wrote a book called Lessons for the Young Economist. Thank you for joining me for a podcast. I appreciate it.
Thanks for having me. Good to be here.
Okay, well, first question I wanted to ask you is related to Austrian economics. And in the past, I've noticed that a lot of Austrian economists are able to predict boom and bust in the economy a lot accurately than the mainstream economists, especially when it came to the housing bubble back in 2007 and then the dot-com bubble back in 2000. How come you guys are able to predict the boom and bust more accurately, and the mainstream economists like Bernanke and Paul Krugman cannot do that?
Well, you're right. Many Austrian economists had predicted the dot-com crash and the housing bubble. And if you look at some of there's been a lot of compilations. You know, if your listeners who are hearing this, if they Google, Austrian economists call housing bubble, you can see all the different examples of that. I personally was a little bit behind the curve, but you're right. Even I had figured it out by the summer of 2007, which was pretty late compared to a lot of the other people called it earlier. But you're right. If you go to YouTube and type in Ben Bernanke was wrong, you'll see that the current Fed chair was just consistently misdiagnosing the economy from like 2004 onward. At every stage so during the bubble, he denied there was a bubble. And then, as it started popping, he said, it's going to be contained to the subprime sector. Then they said, it's not going to spread to the larger economy. And they said, it's going to be a mild downturn. So, it was systematically wrong. So if you're asking, what is it that the Austrians have that gives them this ability to see trends in the economy that I think a lot of other economists lack? Well, it's because we think we're right. We think that we understand what it is that causes the familiar boom-bust cycle, specifically when the central bank pushes down interest rates. That gives a false signal to entrepreneurs to start longer-term investment projects. There's not enough real resources to complete those projects, but it gives rise to a few years of apparent prosperity, and that's what the boom is. But then eventually it has to come crashing down. So in the Austrian view, the recession is the result of the prior unsustainable boom, and the way you stop the cycle is to stop doing the typical remedies like lowering interest rates and having big government deficits during the recession. You should just let the recession run its course and then let the economy get back to a steady growth path.
And a lot of people don't understand the role of the interest rate in a free market economy. You hear a lot of people saying, we should raise the interest rate then we'll have deflation in the economy, because then the money supply would contract, and that'll be good for the economy, because then people can start saving. Then they'll have incentive to save, which will create when people save, it'll create more capital and therefore create more jobs. So can you explain briefly the role of interest rate in a free market economy and how it works, and what indicator it sends to entrepreneurs and people that run businesses?
Sure, yeah, and that's another major difference between, you earlier mentioned Paul Krugman. So the typical Keynesian view versus the Austrian view, you're right, the way they approach interest rates is pretty different. So the Austrians think that the interest rate serves to coordinate activities over time. And so it has to do with the fact that, right now, the resources that we use in production, they can be used to make goods that are designed to serve present desires or needs. So, like food and movies and things like that, DVDs, stuff that are called present goods or consumption goods. Or the resources can be used to produce goods that won't really ultimately serve consumers except down the road. So, like if you make give you an example, if you make a sports car, that's a present good, whereas if you make a tractor, that's a future good, because with a tractor is like a productive good that's useful for making, for harvesting more crops in the future, all right? But the tractor per se is not directly useful the way that a Ferrari is or something like that, all right? So the Austrians think that the interest rate in the market economy helps to balance that. If people are very patient and they want to devote resources to making goods that are ultimately going to give them happiness 20 years from now, well, then the households save more, and that pushes down the interest rate, and that allows businesses to borrow and invest in long-term projects. So it all dovetails. And if people are very impatient and they want resources channeled into satisfying immediate needs, then people don't save much. So the interest rate is really high, and then so businesses only invest in very short-term projects because they would say the cost of capital is so high. So that's the way the Austrians view it, that the interest rate helps regulate or coordinate the structure of production and how long-term or short-term oriented it is. And that kind of analysis is utterly lacking in a typical Keynesian model, where they think the interest rate just serves as a brake on total spending or total investment, but they don't look at the composition of the investment. They can't tell whether you're investing in 20-year projects or 2-year projects. They just talk about investment per se.
And a good example of that is what happened back in 2000 after the dot-com bubble, when the Federal Reserve started, well, in 2001, when the Federal Reserve started lowering interest rate. That sent a false signal to the economy, and in result, it misallocated resources to the real estate sector, and that causes a bubble in that whole industry, and it lasted into 2007.
Right. So the Austrians, again, think that, if you agree with the Austrians, or at least understand their perspective on what it is that the correct market interest rate does in the economy, that it has a function to serve, and that if the market interest rate is 6%, well, that's communicating real information about the world to everybody in the economy. And if the central bank comes in and pushes it down to 1%, like Alan Greenspan did, as you mentioned, he started cutting it in 2000 and brought it down to 1%. That's not really doing the economy any favors. That's messing up the signal. That's changing the information that's being conveyed by that, what should have been a free market price, and now is a distorted price. And so in this particular instance, like you say, I agree with you that the housing bubble, and more generally just the bubble in the stock market that was fueled in the mid-2000s, was at least partially the result of Alan Greenspan's loose monetary policy, where he, by design, that was the whole point. When things looked good, everybody was congratulating Greenspan for cutting interest rates and lifting the economy out of the recession after the dot-com crash and the 9/11 attacks. And then when things blew up, of course, then more people had second doubts. But the Austrians all along were saying, this is not a good policy. You don't make the economy richer by printing money and dumping it in the credit markets.
And I agree with you there. But another subject I want to talk about is the hyperinflation, inflation, deflation. And a lot of people in the past are predicting that hyperinflation is coming to the U.S., but yet it hasn't come yet. Instead, we are going through stagflation, where we have a high unemployment and high inflation. Why hasn't hyperinflation come to the U.S. when the money supply continues to expand year after year?
Well, I personally have been on record telling Austrians that let's be careful and not use the term hyperinflation unless we define our terms carefully. Because I think most people, when they think of hyperinflation, they think that literally the currency collapses and you have 1,000% inflation, things like that. So even if Bernanke did nothing else, if he just sat back and let the money supply grow, the amount of excess reserves that are in the banking sector and commercial banks created as much as they could legally, you might have prices go up by a factor of 10 or so, which is severe. But depending on how long that took, we could argue about, is that really hyperinflation? So if I could just rephrase your question to say, why haven't we had very severe price inflation? Why hasn't the CPI gone up by more than 10% per year? I think there's several reasons. So one major reason is a lot of that new money that Bernanke created is being held by the commercial banks as what's called excess reserves. So they're basically just parking that money on deposit at the Fed instead of using it to lend out and make new loans to people. So in one sense, 90% of what could have been done from what Bernanke did has not been done so far, because the commercial banks have the ability to legally create more money on top of the injections that the Fed makes. And they haven't done that just because for various reasons. And another reason is, I think, just that their prices would have fallen significantly by now if the Fed hadn't intervened. So relative to what would have happened, prices actually are a lot higher. It's just the absolute level's not that much higher, because I think had the Fed done nothing because of the panic and because the demand to hold money would have gone up so much, you would have seen, the CPI drop by 10% by now. So those are some of the reasons I think that we haven't seen prices go through. But and the last thing I'll mention, I think it's a mistake by investors. I think most people in the markets, in the currency markets and bond markets, actually believe Bernanke when he says that we're going to just gradually climb out of this thing, right? Because if most investors saw the future the way I think you and I see it, well, then they would say, well, at some point the dollar's going to crash, and so that would just lead to it happening sooner, and you'd see it reflected in prices. So I think part of it is just Bernanke pumped in a bunch of money. It hasn't hit the hands of the general public yet, and speculators aren't crashing the dollar because they think Bernanke's going to suck that money out of the banking system when the time is right, and that that's not going to blow up the economy or the dollar.
And also, the government have done a good job hiding the inflation, and one of the ways they've done that is they manipulated the CPI numbers. So people out there who are not aware of that think there's not very little or low inflation right now in the economy.
Yeah. I mean, that you're right. That's not a conspiracy theory. I mean, they really, you can go and look at the Bureau of Labor and Statistics and the various changes they've made to how they calculate CPI, and they have all kinds of wiggle room and dials they can twist and so forth. But I mean, even there, I mean, I've been a little bit premature. I thought we were going to see larger price inflation by now than we have, and so and I think one of the reasons is just that investors believe Bernanke more than I do, and I thought more people were going to realize he was crazy by now. But what I guess what I'm getting at is, I mean, if the kind of price inflation that I think is coming were here, the government wouldn't be able to hide that just by changing. I mean, the government could report bogus numbers like they would do in the Soviet Union, but everybody would know this is great. Just kind of like right now. I mean, I was just at the gym and I was walking out and I heard some guy complaining and saying, "Man, groceries are so expensive." So I mean, even though the government's putting out bogus numbers right now, I mean, everybody knows. Come on, the prices really are rising more rapid. But I just mean, I thought it was going to be worse than it had. Like I thought gasoline, they can't lie about what the price of gas is. And it's true. It's higher now much than it was in the middle of the recession, but it's not going through the roof the way some people might have thought it would by now.
Right. So do you think it's possible that we could have a currency collapse in this country?
Oh, well, it's certainly possible. I mean, it's the difficulty with making these sorts of predictions is it's all dependent on what the government and the Fed do between now and when we're saying this event might happen. So if they continue on the current course, I mean, I think what a plausible scenario is that it hits Europe first, that the banks keep getting bailed out by the European Central Bank, and then finally they have to bail out the major governments over there that are insolvent. And then ultimately there's a run on the euro, and the euro itself crashes. And that might give artificial strength to the dollar as everybody flees euros and goes to the dollar. But then mysteriously, the analysts would say, oh, no, the contagion has spread to the U.S., and then we would have the same thing happening here. And, the Fed might bail out the government for a while, but then ultimately people would ditch the dollar. So to answer your question, yes, I think for sure it's possible, and it's even reasonably likely, again, assuming they keep doing the same thing they've been doing, which is basically anytime there's a problem, the Fed just comes in and creates a bunch of new money and says, oh, that solves it. And eventually that's going to stop working. They're going to have to keep pumping in more and more money to get less and less of a result, which is exactly what we see happening in Europe. they keep coming in with these bailouts and solutions to the debt crisis over there, and they keep having less and less potency.
So, in speaking of the Federal Reserve, last couple of weeks they've been thinking about ending the QE program by the end of the year. Do you think the Fed will pull the plug when they have $3 trillion on their balance sheets?
No, to answer the quick answer. I think, again, that's what the reason they have to talk like that, as well as referring to earlier, where the only way Bernanke's been able to get away with this much in printing of new money, metaphorically printing of new money so far, is that it's largely been held by everybody because they assume he's just going to unwind the operations in the future before it hits Main Street, so to speak. And so that, I mean, the Fed kind of has to be telling people, because now they're asking, well, what's the exit plan? And give us some specifics here, Bernanke. So they have to do that, but I don't think the economy is going to be better by the time they have to do it. Or if they do start, if the economy does seem like it's recovering, and then they start unwinding their programs, I mean, that's going to put a damper on it. And then, unemployment will start going up again, and people will complain. So I think that they're going to err on the side of causing much larger price inflation than we've seen before they crash the economy again.
Yeah, and I give the Federal Reserve a lot of credit. They have a great public relation department because they've been able to sort of manage and manipulate the market expectation when it comes to inflation. Because, when they come out and they say, oh, we might exit our QE program by the end of the year, and as you can tell, gold price should go down and the inflation expectation goes down. So I give them credit for having a good PR department.
Yeah. No, I mean, you're right that it is kind of amazing that they are able to do the stuff they've done, and they haven't terrified everybody.
Well, the next topic I want to discuss is Bitcoin. A lot of debate going on out there whether Bitcoin could be considered money or not. So I want to ask your opinion on that. Do you think Bitcoin should be considered as money?
Well, I mean, the standard economist definition of what money is that it's a medium of exchange, meaning it's something that you sell real goods and services for because you intend to use that same thing to then trade away and get other goods and services. So clearly Bitcoin is a medium of exchange because, as we speak, people around the world are giving up valuable, things that give direct utility to get Bitcoin, and they only intend to use the Bitcoin to buy something else down the road. So it's already a medium of exchange. And then the other leg of the definition, though, is to say that's commonly accepted. And so, and that's not, there's not a crisp way to define, well, what does that mean, commonly accepted? So I would say right now that no, Bitcoin is not money because I wouldn't say it's commonly accepted, but it could be. In my mind, there's nothing in the nature of Bitcoin that would make it impossible to become money at some point if enough people embrace it and start using it.
So do you believe Bitcoin is better than like the U.S. dollar as a fiat currency, or do you think it's just as good as the U.S. dollar, and do you consider it as fiat money?
Okay. Well, for sure, I think Bitcoin's better than the U.S. dollar just because, it depends what you mean by better, but certainly from a moral, libertarian, ethical standpoint, it's better because it's voluntary. No one's forcing you to use Bitcoin. People, you know what I'm saying. There are various coercive things in place to keep the dollar as the currency that Americans use. As far as what is people say, is Bitcoin a fiat currency? Well, again, it depends what your definition is. If fiat currency means nothing is backing it up, so that it's not a claim on some other commodity, then Bitcoin is a fiat currency because Bitcoin is not a claim on something else. It is what it is. But if some people use the phrase fiat money or fiat currency to mean it's backed up by government fiat, in which case Bitcoin is not fiat money. So it depends. I use fiat in the former sense, so in that sense, I would say Bitcoin is fiat money, but it's voluntary, privately created fiat money.
And that's an excellent point there. And people haven't noticed lately that Bitcoin was in a bit of a bubble, and this past week the price had collapsed. And there was also a lot of debate whether Bitcoin was in a bubble or not. And as we found out, it is in a bubble, and it burst last week. So my last topic I want to discuss in this podcast is that you've written in a book the concept of becoming your own banker, which is a book written by R. Nelson Nash, and this concept is not really popular in the mainstream media, or it's not popular in mainstream finance either. So do you mind explaining to our audience the concept behind this, and why has it become rather well known within the Austrian economic circle?
Sure. So, as you said, this guy Nelson Nash wrote a book called "Become Your Own Banker," and he called this thing called the infinite banking concept. And then my co-author Carlos Lara and I had a follow-on book a few years later called "How Privatized Banking Really Works," where we tried to integrate this infinite banking concept with the Austrian economic worldview. So what Nash realized, he had come out of the insurance sector. He'd been in it for many years, and he had this epiphany of sorts, and he said, Americans should not be reliant on commercial banks, because Nash had some bad experiences with bankers, and he didn't like the whole system, and he was a student of Austrian economics, so he understood the dangers of fractional reserve banking and all that kind of stuff. And what he just discovered is this centuries-old financial instrument called a whole life insurance policy could allow you, if you sufficiently capitalized it, to become your own banker. And all he meant was, so a whole life insurance policy is what's called permanent life insurance, and that means it stays in force. So it's not a term policy that there's a certain term and then it expires, and if you didn't die, well, then that's it. What a permanent life insurance policy is, it means it stays in force your whole life up to some cutoff date, at which point you get paid the face benefit, the face amount, if you're still alive. And so you build up what's called cash value in these things. It's sort of like building up equity in a home, except it's not a house. It's an insurance policy, because the insurance company holding it knows they have to either pay you the death benefit if you happen to die, or if you reach the maturity age, which nowadays in contracts is 120 years old, then they got to pay you the face amount also. So that they're taking your premium dollars and investing them in assets on your behalf, growing this stockpile of assets, because they know they're going to have to pay you either when you die or when the policy matures. So you're allowed to borrow against that. And so what Nash discovered is just that this is a very convenient mechanism. There's a lot of tax advantages, and it's just very flexible as a way to, as like a headquarters for your money. So instead of keeping your money in a checking account or a savings account or putting it in stocks in Wall Street, Nash said, he advised people that you should take out very large life insurance policies on yourself, and that's where your wealth should reside. That should be the headquarters of your money. So that's the basic idea. And as you say, it's not popular in the mainstream financial press. People like Susie Orman or Dave Ramsey, the financial gurus that have audiences of millions of people, and advise them on their financial matters, they ridicule anyone buying a whole life product, because they say that it's a terrible investment and so forth. But I think their critiques are overlooking the what can be done with these things if you design them properly.
Right. Yeah, I think they advocate more of the term life insurance rather than the whole life insurance, because they say you could get term life insurance and pay cheaper rather than whole life insurance where you got to pay more. But I think they're, as you said, they're overlooking a few certain key advantages of whole life insurance. And I know a lot of people out there that've been using these type of life insurance to finance their purchases and their own business doing that. So this is the whole idea of becoming your own banker. So instead of going to a bank, you borrow against your own policy and you pay yourself back.
Yeah, right. I'm glad you said that, because I didn't mention that when you asked me before. And that, you're right, to get your listeners to understand the basic principle here. Exactly right. So again, the insurance, your life insurance policy, as you age and keep making those premium payments, you're getting closer and closer to the payout date, because statistically you're more likely to die the older you get, and in any event you're getting closer to the age 120 when, if you happen to still be alive, they got to pay you. So so the market value of that insurance policy, if you keep it in force by making premium payments, keeps going up, and so that's like the collateral against which the insurance company will lend you money. So, like as you say, what Nash recommends is any time during your life when the normal household would seek financing from an outside banker, like a commercial bank, like if you're going to go buy a new car, the average American goes and gets a loan from somebody, and then he makes his car payment for the next 5 years. And so Nash says, don't go borrow the money from somebody else, borrow it against your insurance policy, and then you're still making your car payment every month, but really what you're doing is paying off that loan that's a lien against your insurance policy. And so in effect, and it's a little bit subtle, but Nash says you should pay yourself the same amount even if the insurance company is charging you a lower interest rate, and then that difference is going right into your policy. So the point is, by using the same cash flow that you would have done anyway had you done it the standard way and went and borrowed money from somebody to go buy a car, then you pay off your car loan, with the same out-of-pocket cash flow, you end up padding this insurance element because you're buying more insurance every month, since typically the insurance loan will have a lower interest rate than the conventional auto finance loan.
Right, and as you mentioned before, so this is a counterattack to the fractional reserve system that we have in this country, and is this the reason why it's becoming well known in the Austrian economic circle?
Yeah, I mean, I don't know how well known it is yet. I mean, that's Carlos Lara and I are doing our best to try to publicize Nash's work within the broader Austrian community, and certainly more people have heard of it now than 2 years ago. But I still think we got a lot of work to do to get the message out. But you're right. That's what you just put your finger on, is the specific contribution that Carlos and I made in our book, How Privatized Banking Really Works. And the PDF of that is online if people want to just Google for that title. So Nash had the whole foundation there. And like I say, Nash had been a student of Austrian economics, so he knew all this stuff, but he never in his work quite made the connection and made the point that, if you're somebody who agrees that fractional reserve banking is problematic and causes these boom-bust cycles, as the Austrians have diagnosed, if you as a household do your financing via insurance loans rather than going to the commercial banks, well, then you're not part of the problem. And so that was the aspect that Carlos and I pointed out to try to show Austrians that, hey, this guy Nash is really onto something important here. The more households that do things his way, then the fewer households who are part of the fractional reserve system that you acknowledge causes the boom-bust cycle, right? Because the commercial banks can't cause a boom-bust cycle if no one's borrowing from them. That's the way the commercial banks create new money, is they have to give loans to people. And it's by the act of granting the loan that money now is created out of thin air. But if everyone's getting their loans from – because the insurance companies can't inflate the way a commercial bank can in our present system, right? So when the insurance company lends you money – that's in a sense 100% money that they have to get it from somewhere. They have to sell off assets, or they have to redirect incoming premium payments to give you the money. The insurance company can't just credit your account with them the way a commercial bank, when they grant you a loan, strictly speaking, they just add numbers to your checking account balance. I mean, there's regulations and things, but in essence, that's what they're doing when they grant you a loan. It's not like they just open a vault and give you money that's there free and clear. Or if they do that, it's because somebody else thinks that money is theirs. And so now the same money is, in a sense, in two people's checking accounts at the same time. So that's the weird way that commercial banks work. Insurance companies can't operate like that. And so if you bank through this so-called infinite banking concept through insurance policy loans, the point is you're not part of this fractional reserve banking problem.
Right, and if people want to learn more about becoming your own banker, they should pick up Nelson Nash's book and your book as well. And there's also a couple other books out there, like Bank on Yourself, that talks about this concept. And I recommend a lot of people to check it out because it's a good alternative for people that want to retire to have this as a fixed income when they retire rather than having a 401k or an IRA.
Yeah, like I say, it's you even without the ideological elements or the notion, the understanding of Austrian business cycle theory. This is a very sensible component of just our standard financial planning. At least if you're conservative, it would make sense if you sat down with a regular financial planner who was aware of how you could use permanent life insurance. It's a very straightforward thing, and to put your genuine savings where if you need to have dollar-denominated assets, and it's a very safe place to put it because, as you say, put in the stock market. I mean, the stock market dropped 40% in 2008. So the people who had the bulk of their savings in whole life policies came through unscathed, whereas the people that were in the stock market had heart attacks. So this is it is, as you say, it's a very conservative thing to do. And it has all these additional benefits once you realize the Austrian diagnosis of what causes the boom-bust cycle.
Right, and also it has great tax advantages as well. So I definitely think people should check that out. And it's hard to explain this concept in a half-hour interview. So I definitely recommend people to check out the resources out there about becoming your own banker. And Robert Murphy, I appreciate your time. So people want to find out more about your work, and where can they go?
They were just pointing to my website, so that the name of it is Free Advice. So if you just Google Bob Murphy Free Advice, it should be one of the top hits. It's at my website, Consulting by RPM, but the way to remember is just type in Free Advice Bob Murphy into Google, and you'll find it.
Okay, great. Well, I appreciate your time, and hopefully you can come back again.
Oh, yeah, sure. Thanks for having me.